In this lesson, we want to look at another important topic, another important accounting standard that has to do with International Financial Reporting Standard 2, which is share-based payment. In this video, we are basically going to look at the objective, how an entity is supposed to account for share-based payment transaction, how to recognize, how to measure, how to present and then disclose transactions that pertain to share-based payment. And also, we'll basically look at why the introduction of this particular standard. We'll look at the types of share-based payment transaction. Basically, we have two, but in certain circumstances, we may say that we have three basic types of share-based payment transaction. How do we account for these types of basic types of share-based payment transaction? That is the focus of this particular lesson. Please, if you've not subscribed, kindly subscribe to RONAS Academy and share with others so that we can increase and widen the learning community. Please, the only thing you can do to support this course is to help us share these videos with other business students. So please, before you continue to watch, kindly share. And also, do not forget to like the video, comment below. It's very important. It gives an implication to YouTube algorithm, how to, make our video appear on a search. Okay, so it's very important that anytime you are watching a video, you click on the like button. You also share with others and also comment below. If you don't have anything to say, you can just say thanks for this video as a comment section. Please kindly do this to help us increase our learning community on YouTube. Alright, so as I indicated earlier on, our focus today is going to be on International Financial Reporting Standard 2, which has to do with share-based payment transaction. Alright, before we start the important thing, the objective, the scope, and the definition, we want to look at why the introduction of this particular standard, because it's one of the novel standards, one of the new standards that have been established by the International Accounting Standard Board. Alright, why this standard? When an employee of an entity works for that particular entity, that employee is being paid salaries. That employee is being paid wages. That employee is being paid some remunerations, bonuses, incentives to that employee. And when that happens, the entity recognizes such transactions in its financial statement. However, when an employee works for an entity and the entity in paying for the services rendered by the employee issue equity instrument or share options to the employee, such a transaction is not recorded by the entity. And this is an anomaly when it comes to accounting. So to rectify that issue, to rectify that anomaly, the ISB issued the International Accounting Standard 2, which has to do with share-based payment transactions. So the objective is how an entity will account, in fact, will account for share-based payment transaction, how to recognize, how to measure and present share-based payment transactions. Alright. In this particular presentation, I'm not going to go chronologically with the objective, scope, definition. I'm going to jump them to establish our understanding of the standard. So first, before we go to the scope, we are going to look at the meaning, the definition of share-based payment transaction. I also mentioned some two key terms in my introduction presentation. I said when an entity issues to the employee an equity instrument and share option. So in this particular standard, we have to establish the meaning of equity instrument and share option. And I'll also explain that before we go to the scope. Now, what is share-based payment transaction? According to IFRS 2, if you really want to establish the understanding of share-based payment transaction, then it needs to be explained in two different perspectives. That means two definitions or two statements made up the definition of share-based payment transaction. According to IFRS 2, we say that a transaction is a share-based payment transaction when an entity receives goods or services from the supplier of those goods and services, including an employee, under share-based payment arrangement. So technical works. What that statement simply means is that when an entity receives goods or services, and those goods or services can be provided by two categories of individuals, either a supplier or an employee of the entity. So employee will basically render services to the entity. So when the entity is receiving goods or services, and those goods or services are coming from a supplier or from an employee of the entity, and in exchange the entity is issuing equity instruments or is issuing equity shares to the supplier or to the employee, then we say that transaction is a share-based payment transaction. For instance, let's say an entity A is receiving goods from from a supplier, or an employee has rendered services to the entity A. And in return of paying for this, the entity is issuing what we call equity instrument, or we call share option. Instead of paying with cash to the supplier, instead of paying with cash to the employee, instead of paying salary to the employee, in return, the entity is issuing equity instrument or a share option to the employee or to the supplier. When that happens, then we are basically saying that that is a share-based payment transaction. Reiterating what the standard indicated, that share-based payment transaction, it is when an entity receives goods or services from the supplier of those goods and services, including an employee, under share-based payment arrangement. Share-based payment arrangement. That is the first definition for the standard of the day. Share-based payment transaction. Two. According to IFRS 2, share-based payment transaction is when an entity incur an obligation to transfer a transaction to a supplier. It's when an entity incurs an obligation to transfer a transaction to a supplier under share-based payment arrangement when another group entity receives goods or services. What it simply means is that there are some times where an entity will receive goods or services from a supplier or from an employee, and the price of those goods and services will be determined based on the share price of the equity instrument of the entity. When that happens, an entity is incurring a liability, but that liability is going to be based on the price of the equity instrument of the entity. When that happens, we are saying that that is a share-based payment transaction. For instance, there is a transaction between entity A and then a supplier, and the price of the goods and services that are being transacted depends on the price of the equity shares of the entity. When that happens, we are saying that that is a share-based payment transaction. So share-based payment transaction is basically when an entity receives goods or services and in return is going to issue its equity instrument or share option, or the entity receives goods and services and the price of those goods and services are determined based on the share price of the entity. When that happens, we say it is a share-based payment transaction. It's a share-based payment transaction. So having understood what is share-based payment transaction, we now want to look at the scope. Now I will explain to you in this, in the definition, I was mentioning some two keywords. I was mentioning equity instrument, and then I was also mentioning share option. What does it two mean? When we talk about equity instrument in IFRS 2, we are basically looking at the ordinary shares of the entity, the capital or the share capital of the entity, the ordinary shares of the entity. You know, we have different types of shares. We have preference shares and ordinary shares. So when you hear equity instrument in IFRS 2, we are basically making reference to the ordinary shares of the entity. Now, share option. Now, if you look at option, we are taking the share away. Option is a contract that gives the holder some rights, but not an obligation. It gives the holder some rights, but not an obligation to, some future item, which the price is determined today. So when we quantify the option to be a share option, then it is a contract that gives the holder the right but not an obligation to subscribe to certain number of shares at a predetermined price. So share option is basically when we enter into a contract together that, in the next 3 months, we'll issue to you 2,000 equity shares, and the price will be determined today, and the price today is, let's say, $1. If that happens, we determine the price today. So whatever the price will be in the future does not affect the contract. When that happens, we say that is a share option. A share option. We have different types of option. So this one is what we are looking at, share option in this particular standard. Now let's look at the scope of IFRS 2. The scope of IFRS 2. What the standard cover and what the standard does not cover. So we are looking at the scope. Now, the standard cover all share-based payment transactions, including when a member of an entity, it can be a shareholder, will buy or receive goods and services and will require the entity to pay on its behalf. Such a transaction is governed under IFRS 2. Please take note. A situation where an employee of an entity enters into a contract with the entity to acquire the equity instruments of the entity, that is not a share-based payment transaction. Example, let's say an employee in the position of, let's say, a director is acquiring some shares of the entity. That is not treated under IFRS 2. It is when that employee is providing services to the entity, and in return of the employee's remuneration, the entity issues an equity instrument or a share option to that employee. That transaction is what we are referring to as share-based payment transaction. But if the employee and the entity enter into a contract or an agreement to acquire the equity instrument of the employee, that is not a share-based payment transaction. In the process of acquisition, which is accounted for under IFRS 3 business combination, an acquirer or a parent entity may acquire an acquiree, let's say a subsidiary in terms of when there is control, or an investee. And we know that there are different ways or different approaches for which a parent entity or an acquirer can acquire an acquiree. One of them is by issuance of shares. So a parent entity, an acquirer, an investor entity can acquire an investee, an acquiree, or a subsidiary by issuance of shares. When an entity, in fact an investor, is acquiring an investee by the issuance or exchange of shares, that is not accounted for under this particular standard. It's not accounted for under this particular standard. It doesn't count there. However, if the investee's employees will continue to provide services to the group entity, and for that matter, there will be issuance of equity instruments to the employee of the investee, that is also falling within the scope of IFRS 2. Once again, under IFRS 9 and IAS 32, that has to do with financial instruments, when an entity is exchanging a non-financial assets with a financial instrument, that is not also accounted under IFRS 2. So if an entity is exchanging a non-financial asset with a financial instrument, is not also accounted for under IFRS 2. So basically, this is the scope of IFRS 2. Make sure to understand the transactions and activities that are governed by IFRS 2 and the transactions and activities that are not governed by IFRS 2. Kindly take note. Alright, so having understood the meaning, the scope, the objective of IFRS 2, we now want to look at the types of share-based payment transactions. So like I indicated, there are two basic types. That's the standard goes ahead to give us three. So two basic types. Let's look at the two basic types. And you see why I was mentioning that that we can get the three. So the three, I'll push it inside to indicate that it's not a major one. And we have what we call equity. The first type is equity settled share-based payment transaction. Then the second one is what we call cash settled share-based payment. Oh, I didn't bring the payment at the top. Payment, so payment is here. Payment transaction. So we have two basic types: equity settled and cash settled share-based payment transaction. And also the third one is when an employee or the entity are having the choice to choose between the two. So when we are having the choice, the entity or the employee here are having the choice. So let's mention here we have the entity and the employee having the choice to select between one or two in accounting for a share-based payment transaction. When that happens, then we are going to the third one, the third type, when the entity is having the choice to select between these two. So in this particular presentation, like as I indicated earlier on, we want to basically look at how do we account for these various types. How you account for them differ. How you account for an equity settled share-based payment differ from how you account for cash settled share-based payments. So you'll take them one by one. So starting with the equity settled share-based payment. What is it? How do we account for it? And how do we subsequently how do we measure them? How do we subsequently measure them? And how do we present them in the financial statement of the entity? Now, before we take them one by one, let's look at the meaning of the two. Now, when we talk about equity settled share-based payment transaction, it is when an entity receives goods and services from a supplier or an employee, and in return, that entity is going to issue an equity instrument or a share option as a consideration to the supplier or to the employee. When that happens, then we are saying that is an equity settled. You receive goods and services, and instead of you paying cash, you are issuing your shares. You are giving the employee a share option. When that happens, then we are saying that is an equity settled share-based payment. However, if the price of the goods and services received from the supplier or from the employee are determined based on the equity price or the share price of the entity, then that becomes a cash settled share-based payment. So you recognize liability, and that liability is based on the share price of the equity instrument of the entity. And that happens, then we are saying that that is a cash settled share-based payment. That is a cash settled share-based payment. Having understood the two, we now want to take them one by one. So starting with the first one, equity settled share-based payment transaction. Equity settled share-based payment transaction. All right. So what goes into the recognition, the measurement, the presentation and disclosure of equity settled share-based payment transaction? Already we have established the meaning of equity settled share-based payment transaction to be when an entity receives goods and services from a supplier or from an employee, and in return, in exchange of those goods and services, the entity is issuing an equity instrument or a share option. When that happens, then we say that is an equity settled share-based payment transaction. How do we recognize an equity settled share-based payment transaction? Now, the recognition of equity settled share-based payment transaction depends on how the goods, or depends on the types of the goods received from the customer or from the employee in terms of services. If the goods or services received are consumed immediately, they are goods that immediately they are received, they are consumed. Look at services. They are services that are consumed as the employee provides those or render those services. So in that case, we are going to debit what we call expense. In the case of inventory, when an entity is acquiring an inventory in share-based payment transactions, when those inventories are sold, then they become an expense, but in their form, they are an asset. Another instance is that you may receive a non-current asset in the share-based payment transaction. For instance, a PPE, a vehicle, a patent, an intangible asset. When that happens, those assets are not consumed immediately. For that matter, you still have to debit what? Assets. You still have to debit assets. So when there is a share-based payment transaction, and that is an equity settled share-based payment transaction, we are going to debit expenses depending on how the goods or services are being consumed, or an asset also depending on the types of goods we are receiving. There are in fact some expenses that are even consumed before they are received. The good or the project is received. A typical example is an expenditure at the research phase of an internally generated intangible asset. When we are internally generating an intangible asset under IAS 38, the expenses at the research phase are even incurred before the actual project is being completed or is being done. When that happens, we are saying that we are going to debit expenses, and automatically we are going to credit equity. We are going to credit equity. Now, the standard provides that we sometimes recognize the equity not in the stated capital, or we recognize it in the other component of equity. We recognize it in the other component of equity. So that has to do with the recognition and the recognition of what? Of equity settled share-based payment transaction. When do we recognize it and how we should recognize it? Now let's look at measurement. And this measurement basically has to do with the initial measurement. It will interest you to know that we don't have subsequent measurement when it comes to equity settled share-based payment transaction. We don't have subsequent measurement. It will interest you to know. The standard says that an entity must recognize or must debit its assets or expenses and a corresponding credit in equity, measuring it directly. So we may measure an equity settled share-based payment transaction, the goods and services that are in the contract, we may measure it directly. Now, what it means, what is the meaning of measuring your goods and services directly? It simply means that we are going to measure the goods and services at their fair value. So measuring the goods and services, or measuring equity settled share-based payment directly, simply means that we are going to use the fair value of the goods or services being received by the entity. But there are some situations where we cannot determine the fair value of the goods or the services. There are some situations where we cannot determine the fair value of the goods and services. For that matter, the entity provider, we have to measure our equity settled share-based payment transaction indirectly. So situations where we cannot measure our equity settled share-based payment transaction directly, then we have to resort to measuring it indirectly. Indirectly means that we are going to measure the goods and services using the fair value of the equity instrument of the entity, or the equity instrument. Already we have established the meaning of equity instruments. So if we cannot establish the fair value of the goods and the services, then we are going to resort to measuring our transaction using the indirect method. An indirect method simply means that we are going to use the fair value of the equity instrument. So for instance, there may be sometimes, in most cases, when employees are providing services to the entity, you see, those employees, we don't have an active market for them to go and determine their fair values. We don't have an active market for the services being provided by the employee to the entity. So for that matter, we cannot ascertain the fair value of those services. So we have to resort to the indirect approach in measuring the equity settled share-based payment transaction. But please, when we want to use the fair value of equity instruments to measure goods and services received from a supplier, then there is a rebuttable presumption that we must take into consideration. So, when we want to use this indirect method for goods and services provided to the entity from the supplier, then there is a rebuttable presumption. When we talk about rebuttable presumption, they are conditions that are not certain. Okay, they provide room for exception. They provide rooms for exceptions. All right, so rebuttable presumption. All right, so when we are using this method for a supplier, there is always a rebuttable presumption that the fair values of the goods and services will be ascertained by the entity. So what it simply means is that in a question or situations where the goods and services are provided by the supplier, and then they have provided you an information with the fair value of the equity instrument and the fair value of the goods and services, you are going to use the fair value of the goods and services. You are going to use the fair value of the goods and services at the grant date. We will look at that very soon, what the grant date value means. Hello, let me say this again. There is always a rebuttable presumption that when we are using the fair value of equity instrument, then with the supplier or with a supplier, there's always a rebuttable presumption that the fair value of the goods and services will be ascertained. And I was saying that in a situation where we have the fair value of goods, the fair value of the equity in the question, but those goods are being provided by the supplier, then we are going to use the fair value of the goods and services. But that rebuttable presumptions can be rebutted when we cannot ascertain the fair value of the goods and services. So the rebuttable presumption can be rebutted or can be abrogated. We can have exceptions. There are situations where we cannot ascertain the fair value of the goods and services, then we can resort to the indirect method. So that has to do with the rebuttable presumption. Rebuttable presumption. Now let's look at other important principles governing equity settled share-based payment. Now, when an entity is granting an equity instrument to or a share option to an employee based on the services rendered by the employee, sometimes those issuance of the equity instrument or share option comes with conditions. That's, oh, I'm giving you this equity instrument, but you have to stay in the business for so years. Or you have to meet certain share price targets, or you have to meet certain sales targets before we can give you, or before we can issue to you the equity instrument or share option. When that happens, there is a way you would treat such a transaction. There's a way you would treat such a transaction. So let's take each of the principles one by one. So if there is a contract between an entity and an employee, and that transaction is equity settled share-based payment transaction, then these principles, you have to look at them in the question. The first thing is, does the transaction vest? Does the transaction vest? Then what's the meaning of vest? What it means is that there is no service or there is no performance condition attached to that particular contract. So that at that date, the employee becomes unconditionally entitled to all equity instruments or share options that is being issued by the entity. If the transaction reverses, it means that there is no service condition, there is no performance condition. That is the transaction best. So on that date, the employee becomes unconditionally entitled to all equity instruments and all share option that is being issued by the entity. What this statement simply means is that if we enter into a contract today and there is no service and the supplier is not required to, meet any criteria or meet any condition, then automatically we can recognize the total value of the goods and services that are being received and the total equity instrument that is being issued to the respective counterparty. However, if the transaction do not vest, then the equity instrument will be paid in the future over the vesting period. Let me break these statements down. It simply means that in a question, when there is a service condition or a performance condition, then the payment of the equity instrument to the employee will be a future thing until those conditions are met before. And it is going to be a future thing, and we are going to issue those equity instruments or share option to the employee over the vesting period. And at the end of the vesting period or at the vesting date, we would have issued all the total equity instruments to the employee. If you carefully listen to the presentation, you will hear me say that service condition or performance condition, that means there are different types of conditions, and the different types of conditions have different accounting treatments. So if you don't know the different types of conditions, you cannot even account for an equity settled share-based payment. Now let's look at the different types of condition and how we are going to account for each of the conditions. The different types of the conditions and how we will account for each of the conditions. Once we are done, we will take a practical question that will help us to augment our understanding, and we can also solve all other practical questions we may encounter when it comes to share-based payment transaction. Do not forget, we are still looking at equity settled share-based payment transaction. When we are done with this, solve a question to establish our understanding, then we can move to the second type, which has to do with cash settled share-based payment transaction. All right, so we want to look at the service condition, but before then, let me just pass this statement. Very, very important. Let me just pass this statement. Very, very important. In the determination of the fair value of the equity instrument, I'm going to mention it when it comes to the service condition, but let me do this before I go there for the understanding sake. Okay, so when we are using the indirect method, we know that we are using the fair value of the equity instrument. There are sometimes also we cannot determine the fair value of the equity instrument, and then when that happens, the standard provider is either we use what we call intrinsic value, or we use the number of shares that is going to be issued during the vesting period. When that happens, we have to go and use either the intrinsic value of the transaction, or we use the number of shares that is going to be issued during the vesting period. This is a situation where we cannot also use the indirect method, when we cannot ascertain the fair value of the equity instrument of the entity. And it is going to be a rare situation, a very, very rare situation. Then we go for the intrinsic value. Now, the intrinsic value is basically the shares that will be issued to the share price, okay? Then the share price that will be issued to the counterparty, which is the supplier or the employee. The difference between that share price and then the share price of the equity instrument, the estimated share price of the equity instrument, the difference is going to give us the intrinsic value. So We cannot determine if we cannot determine the fair value of the share price of the equity instrument, then we have to look at the usage of intrinsic value or the number of shares that will vest during the vesting period. That is for that one. So our focus here, let's come back to the performance, the conditions. There are two types of conditions, and how we account for um, equity settled share based payment depends on which conditions that are prevailing in the question. Let's take the first one. The first one is service condition. Service condition. Now, service condition is basically when an employee is required to, be with the business for, let's say, a period of time. Let's say the employee will be issued a share option when that employee will stay for the next 3 years, for the next 5 years, for the next 6 years. When that happens, that becomes a service condition. A service condition. And when it comes to service condition, the share price that is going to be used is going to be the grant date share price, the grant date share price, the grant date share price. And the grant date is the date that the entity and the employee enter into that arrangement or enter into that contract. That becomes the grant date. So don't forget, if it is a service condition, throughout the transaction, throughout the service condition period, if it's 5 years, 3 years, we are going to use the grant date share price. Even if they provide you with share price at the end of the 5 years, at the end of every period, you always use the grant date because it is what? Service condition. Now, let's take note of this also when it is service condition. The number of employees that will be leaving, the number of employees that are expected to leave. Let's say the difference between the number of employees that leave and the number of employees that are expected to leave when it comes to service condition. Now, the number of employees that are expected to leave will be deducted from let's say we are looking at 3 years service condition. So we are looking at year 1, year 2, and year 3, and we are looking at 200 employees over here. Now, in first year, we expect that 10 of the employees will leave, and then 5 actually leave. You will see these questions, you will see this statement in the questions. 10 is expected to leave, 5 actually leave. What you will learn from this is those that you are expected to leave, 10. Now let's come to 2. Year 2, we are expecting that 20 will leave, and we are 7 actually left in year 2. When you come to year 2, it's going to be the total 200 minus those that are expected to leave. Now let's come to year 3. That's the last year. 3 actually leave because it's the last year. We don't expect anything. Then when you come to year 3, it is going to be the 200 minus those that actually leave in year 1, 5, minus those that actually leave in year 2, 7, minus those that actually leave in year 3, which is 3. This is how we deal with employees when it comes to service condition and it is equity settled share-based payments. Please, this is only attributable to service condition. When we go to performance condition, the second one, it will differ. Remember, when the service condition, we use a grant date fair value and look at how we deal with the employees that are leaving and those that are expected to leave. Now let's take the second service condition. The first one has to do with the second condition. Okay. The first one has to do with service condition. Now the second one has to do with performance condition. Performance condition. Now, under the performance condition, we have 2 types, and these 2 types also have different accounting treatments. So we have 2 types. We have what we call market-based performance condition. We have what we call a non-market-based performance condition. So we have market-based performance condition and a non-market-based performance condition. Now, what is a market-based condition? This is when the employee is supposed to meet a share price target. Anytime it is a share price target, that becomes a market-based condition. However, if it is a sales target, profit target, gross profit margin, earnings per share target, then it becomes a non-market-based condition. Share price target becomes market-based condition. Sales target, profit target, earnings per share, gross profit becomes a non-market-based condition. Let's look at how we account for a market-based condition. Now, with a market-based condition, we are also going to use the grant date fair value. But with that one, so far as we have entered into the contract, whatever happens subsequently does not matter. Whether the employee is going to meet those conditions or those employee will not meet those conditions does not matter once we have entered into the contract. That is when it is market-based condition. When it is non-market based, it matters if the employee is not meeting the conditions. There are certain things we will do. If the employee is not meeting, there are a number of share options we will offer. But when it comes to market based, whether the employee is meeting the conditions or not, once we enter into the contract, that is it forever. So we will solve a practical questions and see how it goes. Now, with these two, how the employee is treated is the same. So let's use the same first example. So we have 200 employees. We are looking at year 1, year 2, and year 3. We are expecting that 10 will leave in year 1, 10 will leave in year 1, and 5 actually leave. Then we expect that 20 is leaving, and then 7 will actually leave in year 2, and then year 3 we expect that 3 actually leave. Now, when it comes to performance condition, which is market-based or a non-market based, this is how we are going to deal with the employees. Year 1 is going to take those actually that left and expected, so it's going to take -10 and -5. Year 2 is going to take year 10 actual, so which is 5. It will take the actual leave, not the expected. Then it will now come and take the expected of year 2 and then the actual of year 2. Now year 3 is going to take the 200 minus the actual of year 1, which is 5, the actual of year 2, which is 7, and the actual of what? Year 3. This is the principle of how to deal with employees when it comes to performance condition. I'm taking it again because of its technicalities. Expected is 10, actual that is 5. They will give you, there are clauses in the question that you will see. But you have to be vigilant whether it is a service condition or it is a performance condition in terms of the employees that are leaving. So in that case, I said if we expect 10 to leave in year 1, we will take it. Those that actually leave will also be less. When it comes to year 2, those actually left in year 1 will come, and expected of year 2 will come, then actual leave in year 2 will come. When it comes to year 3, those actually leave in year 1, those that are leaving year 2, and then those that are leaving in the last year. Now, we established that here we are going to use the grant date share price, and that is going to be used throughout. When it comes to the non-market based non-market based transaction, we are going to use the share price at the reporting date. So the share price will change at each reporting date to reflect whether the employee is meeting the condition or the employee is not meeting the condition. It will reflect that. So that one we will take the subsequent measurement into consideration. Whilst with this, we do not take subsequent measurement into consideration. Ladies and gentlemen, that has to do with the conditions when it comes to equity settled share-based payment. Let's look at 2 more theories, then we can now take the practical example. The next thing we want to look at is modification of equity settled share-based payment, modification. And there are 2 things that give rise to modification. The first one is the share price. When the share price is changing, and the second one has to do with the vesting period. The vesting period or service condition is changing. So vesting period. So the period of the contract is changing, and then the share price is also changing. When that happens, the standard says that you must treat those modification as a separate um, contract or as a separate equity settled share-based payment from the date of the modification. So you will continue to treat the original one, but you will treat the new modification as well as a separate contract. For instance, let's say there's a modification and we are looking at a service condition that is taking 4 years, 4 years. And then there's a modification at the end of year one, at the end of year one. That means the modification is going to take place from year two to year three, and this is going to be 3 years, 3 years in total. If you are doing your fractions with the modification, it's going to take 1/3, but the original contract will take 1/4 because of what vest. I said when is the contract does not vest, we are going to issue those equity instruments or the share option over the vesting period. That's why these fractions are coming in over the vesting period. So year one, year two, if you go to 2 or 4. So with modification, we are going to apply the new conditions as a result of the modification from the date of the modification, and we also continue with the original one. Remember, modification as a result of share price or a vesting period being changed. If it is increasing in share price, you will do the new one and add it to it. If it is decreasing in share price, you will do the new one and then the modification one and then less it from the original one before you account for our expenses and then our equity in the case of equity settled share-based payments. Now the last thing is cancellation. Cancellation and settlement. Cancellation and settlement. There are some times where the entity may cancel the transaction with the employee or may settle the transaction with the employee, or the share price becomes exercised. When that happens, when they are settling the employee, the entity must reduce all the equity instruments recognized must be reduced and then paid to the employee. So the equity instrument must be reduced. By the situation where the entity is paying more than the settlement is more than what equity instrument have been recorded, then the excess will be treated in the profit or loss account as an expense. So this has to do with settlement. So if we are settling, it must be equivalent to the equity instrument recognized. But if there is any excess, the excess will be treated as an expense. So this brings us to the end of all the things we have to take into consideration when it is equity settled share-based payments. Looking at the duration of our presentation, we are going to end the theory here and then also take the practical question in a different video. So we are going to take a practical question solely on equity settled share-based payment transaction, go through all the individual conditions, everything we've discussed, we will understand it, then we will now come to the cash settled share-based payment transaction. So thanks for learning with us. We encourage you to share with others to also learn from and benefit from the content we are also enjoying, so that we can increase our learning community. Thank you.